Since the deal between the Kingdom of Saudi Arabia and the United States in the early 70s making the US dollar currency of global oil trade, the American dollar has remained the world's dominant currency, carrying major implications. This deal meant that every country needs US dollars to import oil. This also meant that, unlike others, the US was not required to export goods and services to other countries to earn dollars. The United States only needed to print dollars to ensure its standard of living, its superpower status, and to sustain its military hegemony at the same time. So now you get why Washington cannot ignore any threat to the dollar's dominance. When Saddam and Gaddafi were removed from power, there were speculations in the media that one of the reasons behind their removal was the challenge they had begun posing to the use of the dollar as the currency of their oil trade. Richard Benson, in his piece, Oil, Dollar and the US Prosperity, said if anything put the final nail in Saddam Hussein's coffin, it was his move to start selling oil for euros. John Chapman wrote for The Guardian that there were only two credible reasons for invading Iraq, and one of them was to preserve the US dollar as the world's reserve currency. A decade later and a pandemic later, the dollar's dominance in oil trade appears to be under threat again. Recently, Chinese President Xi Jinping has been aiming for a new paradigm for energy cooperation between Beijing and the Gulf countries, in a bid to promote the yuan's role as a currency for trading in oil and gas. He urged the Gulf monarchs to make full use of the Shanghai Petrol and Gas Exchange to conduct oil and gas sales using Chinese currency. The Wall Street Journal reported in March 2022 that the kingdom was in active talks with China to price some of its oil sales in yuan. Quoting sources, the journal said talks between Riyadh and Beijing over yuan-priced oil contracts have been off and on for 6 years, but has accelerated this year as the Saudis have grown increasingly unhappy with decades-old US security commitments to defend the kingdom. In the evolving global political scenario, Gulf countries are seeing Beijing as an emerging military power and a potential ally. Syed Rashid Hussain, in his piece for Dawn's Business and Finance Weekly, writes that Riyadh needs to balance the two diametrically opposite demands from the US to use dollars for its oil trade and from China to use the yuan. Riyadh and Beijing are also aware that any such move would not be taken lightly by Washington and cause tremors in the global financial order. Part of the reason is that both China and the kingdom are deeply exposed to the US economy. China holds under $1 trillion in US Treasury bonds, while Saudi Arabia also has substantial dollar-dominated assets, including $121 billion in US Treasuries and $608 billion in the US stock markets. Both realize they cannot move in that direction too quickly. Professor P.S. Srinivas at National University of Singapore's East Asian Institute says, any shift towards the yuan settlement will only be gradual as most Middle Eastern currencies are dollar-pegged. The global market is too large and the yuan is not liquid enough. Realizing the impediments, at the end of the visit of President Jinping to Riyadh, there was no mention of any agreement between the two countries on using yuan for their oil trade. They seem to be moving ahead on the issue slowly, discreetly, and carefully. Even though a beginning has been made, the process is going to be long. This was me, Sara Batul, signing off for now. Stay tuned for more updates to Dawn English.